Hello, folks. Got a little anxious and hit that button just a little bit early. So about a minute and a half away. I'm going to slow roll this for a minute. So if you guys want to throw any questions out there into the chat box, feel free to do that. I will keep an eye on it going forward. But I'm going to try and hold off for just about another minute here, make sure that we kind of launch on time. But, while saying that, make sure you guys subscribe with the bell, because the bell lets you know when I come in unannounced. I see some folks popping in here. They might be getting that notification as we speak. So those folks are on top of it. Make sure you hit the like button before you go as well. All right, I'm going to go ahead and kick this off despite the fact that I'm about a minute early here. This is going to be our options guide, and we're going to be cracking the code to trading options here today. How are we going to do that? Well, I'm going to talk about some key aspects that you and I need to look at on a daily basis before trading, or even trading options for that matter. So we're going to build from simple concepts to real life examples throughout this video. And by the end of it, we'll have some real live trades that we'd be able to put on. All right. So, well, not live because we're right after the close. So we'll have to wait to put those on the in the market tomorrow if we decide to go with it. All right, and one thing I want to talk about here is we are going to have a specific strategy today that we're going to be talking about. It's going to be the long strangle. And the strangle is something that takes advantage of a big move, all right? But you need to have certain things happen before you implement this strategy. You have to have the right environment. And we're going to be talking about that. But like I said, before we get to talking about options, you guys have seen this before, especially if some of you folks that have watched this video. This is data transfer. So when we're on computers and data's flying back and forth, it's all being transferred like this. It's like a streaming, raining movement of O's and ones. And that's where the data is transferred. Sometimes it's an 001. That means something different. But with that said, it looks very difficult. But if we pause this, peel back the onion, folks, it does make it a little bit easier. We can see what these things are doing, the levers and pulleys, especially in the options montage. Now, don't run away. We're going to make this so simple by the end of it that I think that everyone will have something to take away from this. All right. If you guys are ready, throw a Y over there in the chat window, and we'll start getting this ball rolling here. All right. What's the best investment one can make? You guys can throw that over there in the chat window too. Let's make this interactive. You guys drive the content here. All right. So one thing that Rockefeller said was that dirt was the best investment anybody could make. Yes, dirt. The reason why he said that was because he felt like, well, you know what? You can make as many widgets as you want, but when you are buying dirt, well, we only have so much dirt, right? So the idea was to buy a commodity or a finite commodity that had a major limitation. Well, land does, yeah. Well, if we continue to grow as a population, we're going to need to take up more land. Those folks that own that land are going to offload that commodity. All right. So most people will say that the house is the best investment. And the reason why they generally say that is because of the housing prices. You can look at it as this: the housing prices continue to climb, right? I mean, if we look at going all the way back to 2000, we've seen several times where we've seen massive spikes moving higher in the home prices. And that's no different than right now. So while it does seem very obvious that folks are buying a house as an investment, have you guys watched housing prices lately, or even been a little bit concerned about what's going on with housing prices right now? Well, if we roll back all the way to basically 2000, the dot-com era, well, we saw housing prices rallying up, into that. Sorry about that, folks. Got a little ahead of myself. We saw houses moving higher through that. During the dot-com, we saw a dip. Again, we saw another rebound all the way till about the financial crisis. We saw those housing prices just plummet, right? And then another rebound to the pandemic. We did get a little bit of a blip to the downside as folks were worried about being in rural area in cities and wanting to move to the rural or the suburb areas. Well, we did see a dip as folks were kind of worried about those houses. They wanted to offload on the high. And I saw some people getting some really nice deals, to be quite honest. And then we've seen this massive rally almost going parabolic as of recently on home prices. What's going to happen now? You know, it's great if you have a crystal ball, like everybody looks at charts and saying, you know what, you should have bought here, you should have sold there. Well, that's easy in hindsight. What we're trying to do is figure out what we're going to do going forward, right? And we don't have the answers going forward. One thing I will say, though, is we have those interest rates, you know, hanging over our head. Right now, Fannie Mae and Freddie Mac aren't accepting any mortgages below 5%. That means we can't get a mortgage below 5% because they can't offload that to Freddie or Fannie. Yeah, there's some other folks out there that are willing to take a little bit more risk and might do that. But for the most part, you won't be getting a loan for less than 5% on a home. What does that do? It causes home prices to level out and even come off a little bit. Why? Because you and I have a budget, right? We know what our income is basically going to be next month, the month after, or for the next year for the most part, right? We know how much income we have coming in. We can guesstimate on bonuses and stuff, but we want to know what exactly is there because that's our budget. And most folks that are financial advisors, I'm not one, so listen to your financial advisor, but they will say somewhere between 20 and 25% of your income can be allocated towards buying a home. All right. So if I can only spend 25% of my income, well, my income hasn't gone up any really. But if interest rates start rising, that means that the amount of principal I pay every month is going to be less because I'm going to be paying more to an interest rate. So if I can pay less to the principal, that means the house that I'm buying is worth less money then. So what we see is that when the interest rates start eating up in that, well, those housing prices have got to start correcting a little bit because people can't afford that price. This is all in theory, folks. This is the levers and pulleys of the markets. Will that fall through this time? Maybe not, but I would expect if the Fed funds rate, which is the prime, is based on prime rate. The Fed funds rate is what the banks use to transfer money, like loan money back and forth. That's the Fed funds rate. Prime rate is the base rate that we watch the interest rates get moved. All right. Fed funds, prime rate is basically the same thing. Then all other interest rates are kind of based on that. So if we get a 4% Fed fund rate, which means we've gone basically from 0 to 4% in a year, well, that means mortgage rates are going to be even higher than that. We're probably talking 6%. All right. So again, that 6% of your overall mortgage, well, that means prices will likely start to correct a little bit. As a matter of fact, we are already seeing this. I am in building as well. We are already seeing this with some houses, especially. I thought the folks that were going to be in the rental communities were going to do very well. That's something that's very popular here in Arizona because millennials don't seem to want to own a car, a house, or anything for that matter, which is fine. But I thought that these housing communities were going to do very well. I'm already starting to hear some hubbubs that they're having trouble filling out some of these places where before they were snapping them up really quickly. Higher prices mean higher rentals. All right. So is that going to start coming off again as people are saying, I can't afford you. I have to go somewhere else to try to find a place. So that makes rentals want to come down as well. All right. Higher prices for the cost of goods going into it. You're not able to leverage that at all because the prices are coming down. It is a very difficult environment, to say the least, for most builders, construction guys, or anything for that matter. If you think about their budgets, guys, they started writing their budgets or their proposals for these jobs that they're doing right now based on last year's prices. The price of PVC is 110% higher than last year at this time. There's nobody that could have foreseen that. All right. So when all of these prices start to rise, especially they start jacking up interest rates to stave off some of that inflation. Well, with that said, that will cause your housing prices to likely come off just a little bit How far is going to be dependent on the economy as well. If we start going into a recession, that's going to even trump these higher prices there. So when folks are talking about, great investments, stuff like that, well, when you're buying a house, the expectation is going to go up, but we've seen in history that it doesn't always do that. So a lot of people will say you just go out there and buy it. You're buying low, then you sell it high. It's that easy. So we could probably get destroyed trying to flip houses in this type of market, right? Because you're buying high, putting money into it at high level prices or at elevated prices, and now you're trying to sell it in an increasing interest rate environment. Housing prices are going down. What's your incentive? It's not a whole lot, but you guys probably know more about that than I do. I'll take your class on that one. But one thing that everybody says when they're looking at a chart is it's pretty easy. All you got to do is buy low and sell high. And as novel of an idea as that is, as simple a concept as that is, it's not so simple, because what folks are usually doing when they're talking about trading, for one, is they're talking about their levels and stuff like that. They'll draw in their support and resistances. I know a lot of you guys out there are probably better chartists than me even, and could put in better support and resistances, but I like to try and pick as many tops and as many bottoms as I can. So when folks say, well, all you got to do is buy down here, maybe at the IPO, and you can sell it anywhere. Basically, you can sell high, super high. That's so easy, right? Well, it's not so easy, because if you get this rally coming up and the market came back down, you might think, all right, this is a buy low type of opportunity. What happens? Is this a sell high opportunity? Well, when we see the chart coming back this way, it's obvious that it's not. But if we said here, this was a buying opportunity, is it? It looks like it's done pretty good, but what happens if it falls out of bed? So when we're looking at charts and trying to discern which direction they're going to go based on buying low and selling high, yeah, we put in those support and resistances. That will help. It's, a little bit more difficult to see its support and resistance on a bullish and bearish move, but we can draw in those lines, and it gives us a pretty good gauge as to where those resistances and supports are, to then try to buy low and sell high. But it's just not that easy, right? I mean, options, though, will give us a tell whether they are cheap. That's the key here. We need to know when we're trading if we're buying low and selling high. Options are the only thing that will tell us if they are cheap or expensive. If I'm looking at a stock, I can't tell if a stock today is cheaper or expensive based on the price. I can look at it from the historical value, right? From 6 months ago when we were a little bit higher, or even 3 months ago when we were a little bit higher, right? Now we pulled back and it looks cheap. But if you put it into perspective, then you can see that, well, even though we've had this pullback and it seems pretty crummy, well, we are still above pre-pandemic highs. Now, if you guys have probably been traders for a couple of years already, or at least know what happened during the pandemic, well, or knew what was going on before the pandemic, it felt like it was a pretty darn strong economy, right? Well, and then we had the pandemic and pulled back from that. Markets rallied based on forward guidance. That's what happens with stocks, is we look at what the stock is doing today, and then based on a multiple of that, because we always think that they're going to do better, right? Based on a multiple, then those prices of that stock are estimated to go higher because of the multiple on today's earnings. But we don't always know what's going to happen 10 years down the road or 5 years down the road, right? I mean, we can see this stuff turn on a dime. Just look at the pandemic. So once our thought process changes a little bit, and the expectations of that move higher start dwindling, that's what we're starting to see right now. People start readjusting those multiples and what they expect out of these companies. So we start seeing that pullback. Now you're going to start seeing more and more people talk about a further pullback from here. All right. I'm probably one of those guys. And the reason why is I don't think the administration is doing anything to try and slow down this inflation. One thing to do is just open up the oil, and oil is driving prices of everything higher, from cost of goods on those transfers. As a matter of fact, I've got a buddy that's in the mortgage company. He has a, I think it was the escrow company started saying that they were going to charge him $25 to drive out to his client and do the paperwork at their place because of a fuel surcharge. Well, he called me up and started talking about it. I was banging it back and forth with him. I was like, for that $25 surcharge, you got to think that person's going to be driving 100, 150 miles, right, to cover that fuel surcharge. So people right now are looking at all of this and trying to take advantage as well. They're getting hit with fuel surcharges. They're flipping fuel surcharges back at everybody. All right. So it's all a game right now, and prices will start to level out. As a matter of fact, my friend went back to him and said, hey, I'm not going to pay you that. I'll pay you like $5 or something like that because the guy's less than 25 miles away. All right. So those are things that we're going to start seeing pushback on some of this. But at the end of the day, everybody is feeling the pain of higher prices and are trying to make up for that because their margins are getting hit so bad. The margin compression right now in business is astronomical. Like every company I'm talking to is concerned about what's going to happen next month. Are they even going to be in business? All right. So that's how scary this is right now. But with that said, one of the best things about options is volatility drives price, and volatility looks like this. Now, one of the rules with options is everything is based on an advancement. Okay. So when we're talking about, when we're talking about the option montage, all of those Greeks are based on an advancement. Okay. So a move higher, a move in time. All right. So that's what we're looking for. All the rules are just based on an advancement. Okay. So with volatility, when we're looking at an advancement, what does that mean? It's an increase in volatility by 1 percentage point. All right. And what is volatility even further? It's just implied volatility. It's the most important volatility coefficient you can find. All right. Yeah, you can look at the VIX. That gives you the broader market. It tells you what everybody's experiencing. But, like today, I'll show you examples of stocks that are actually very low volatility right now, despite the fact that everybody else is experiencing extreme volatility. All right. So what we need to do is compare apples to apples. Like I just said, the VIX is moving higher. I can show you volatility moving lower right now in certain stocks. So we don't want to look at VIX when we're looking at a specific underlying. When we're looking at an underlying, we've come up with our directional assumption. I'm assuming that you folks have already done the legwork. You've gone through charts, and all of a sudden, or you watched something on TV, found a product you love. All of those things help you come up with your directional assumption. So whatever that is, then for that underlying, you need to look at that underlying's implied volatility. All right. That is the most important thing because it tells us if prices are cheap or expensive, right? And volatility looks like this. It is more of a horizontal rather than vertical type of move. I talked about it earlier. Bullish and bearish moves are sometimes harder to see those support and resistance lines. It's going to usually take a little bit more of a trained eye kind of thing to draw those in there. Well, our eyes really line up well with things that are horizontal, just like our eyes want to find happy faces in things. I mean, I just drew 2 dots there and all of a sudden it kind of looks like a face or something, right? Well, it's because our eyes are drawn to that. Our eyes want to see faces. Our eyes want to see patterns, and they line up very nicely with horizontal ones. So with volatility telling us if price is expensive or cheap, well, then we should adhere to that. We know that when volatility for this underlying is at this level, we're going to talk about the levels a little bit more, but I just want you to wrap your head around this. When we're looking at an underlying, any underlying out there, we will see volatility looks like this for it. It has ranges that it wants to stay in. Now, the reason why it's so important to compare apples to apples rather than apples to oranges if I were to compare, say, for instance, a utility, or let's say, IBM, even though it's considered a tech company, to Tesla, who is a tech company, their volatility coefficients are completely different. I cannot look at IBM and say that volatility for IBM is super cheap because look at Tesla. Look how high Tesla is. All right. No, we have to compare Tesla's range to Tesla's range. All right. Because that tells us when the prices are cheap. So like in this example, if I was looking at XYZ, it doesn't matter what stock it is. All right. And volatility is down at this area, at these areas. Well, we know then, based on our rule of if volatility moves higher, prices in the options adjust according to that coefficient. Well, the same thing goes if it goes down. Our prices are going to adjust to the volatility going down. What are those prices going to do if volatility goes down, folks? Throw it over there in the chat window. If volatility goes down, our price is going to go down. Throw a Y or an N over there. If volatility goes down, what happens to those prices? They go down too. They go down based on that coefficient. So this downtick here would have seen the prices start to fall, despite the fact that this underlying didn't move. XYZ didn't move a penny. You haven't heard me talk about that. You haven't heard me even say that a day has passed, all right? Nothing's happened to the stock. It didn't move. If we're just watching volatility come out, we would see those prices just incrementally drop. And even if the underlying didn't move again and the volatility started going higher based on maybe it's just news out there, people chattering on Twitter, we could see volatility spikes based on that anymore. So we could see that volatility move despite the fact that XYZ is unchanged. Right? So as the volatility moves higher, if that volatility is cranking, well, that means that volatility is making price increase. Okay. So the idea here is we can see price when it's cheap and expensive by charting it. Now, I'll show you that even pre-pandemic, we can draw this stuff back. So I'll start moving into some real life examples so I don't bore you guys too much. Let me know if I'm boring you. Spin it, throw some stuff out there. Like I said, you guys are driving the content. Don't forget to, if you have a question, somebody else is going to have that question too. So again, this doesn't matter if it's XYZ, PDQ, ABC, but the underlying has a pretty good line. Now, I like to have a couple of them go through. I don't have to hit every line, but if I'm trying to draw a line in there, I'm going to try and draw it as straight as I can usually. But we could see that generally speaking, we can look at this as it's pretty low, right? So we know that based on even these lows here, it's definitely not high, right? So we can start to see in these different underlyings, I've drawn lines in here. Like I said, I don't mind letting it break through a little bit now and again because that, those get to be extremes. I want to get some of the extremes out of there. I don't mind if I get involved in something like this, right here, and the volatility goes a little bit against me because I knew I was on that line. It's going to gravitate back. It's got to want to stay within these two lines in the sand. Basically, let's call this 47 or something like that, right? You can see when it gets outside those extremes, it wants to pull back a little bit. So we could see that basically we could draw a line right through the middle. If I could do it, 1, 2 bars is kind of like right in here, right? This is your sell zone and this is your buy zone, right? I would wait for volatility, especially right now, if it's coming off, to start reverting before you start getting into that buying, maybe, especially if you're newer to trading options. There's no shame in being a little bit late. It's better than being a little bit early, usually. All right. So, and with that said, with, somebody that is newer to trading options, you could split this into quarters, maybe even, and then even make yours more of an extreme, on those levels. Now, you're not going to have as many opportunities, but you will be a little bit more safe as the volatility may not continue to go against you after you sold it, which means those prices are going higher, right? If volatility is decreasing like this, we know those option prices are decreasing as well, right? Even if the underlying doesn't move. I haven't talked about the underlying's price. We don't care about price right now. We want to just know what volatility is telling us about the options prices, right? So if we see volatility free falling like this, we don't want to be a buyer. That's like the same thing in the stock market, right? You're kind of catching a falling knife, all right? Same thing goes when the market is rebounding and shooting higher. Before it starts rolling over, you may not want to jump in just yet, okay? Wait for it maybe to start peeling over. Just remember, you got to be kind of quick at that game then on your timing on that rollover, because usually when volatility comes out, it comes out really fast, all right? So you won't have as many opportunities, but I like to look at it once it gets up into this upper 50%. I immediately put it on my radar. Those are opportunities to start selling options. Now with this one, you know, you guys might be saying, all right, well, yeah, but pre-pandemic, our volatility right now is really high. You know, we see it in the VIX. It's up, you know, probably in the 30, close to the 30s right now. But what happened in the past? Is it anywhere close? Well, we stretch this back out. I put a mid 50-50 line in there, but you stretch this back out. All I did was hit left click on this, send it out to the side. And you can see, yeah, well, pre-pandemic or this underlying, I don't know what it is, was a little bit lower, but heading into the pandemic, it started getting up into that groove, right? Pandemic hits, massive spike in volatility. You can't foresee this. You can't fear this, guys. This is a black swan event. This is something that happens so rarely, you can't base your life off of it, all right? You do want to keep it in mind, like as a data point, because if we ever get another black swan event, that's probably the place it's going to go again, all right? That is its real extreme for this underlying. But you can see when we draw back, you know, 3 years or so, that this is still pretty in line. So when underlyings have their groove, they kind of stay in that groove, all right, for their volatility. Here's another one. This one has higher volatility, but again, we can draw this underlyings pre-pandemic, and it doesn't look a whole lot different. Right now, we're experiencing a little bit higher volatility as of recently, right? But again, we can still see that we can stretch it out. It's in line. So what does that mean? For the last 3 years, options volatility, implied volatility, has been giving us a clue as to whether or not we should be buying or selling options. And this whole thing really drives me crazy, folks, because I see so many times on different trading chat rooms and on Twitter and stuff like that, everybody like going out there and like talking big game about buying calls and puts and stuff like that when volatility is at extreme levels here. And I shake my head a little bit because, you know, they're really trying to push the rock up the hill, right? The Sisyphean effort. They're fighting headwinds they don't even understand. This volatility comes out. They can be directionally right, but if they bought volatility, when we saw that volatility, let's say, for instance, you buy your stock options around this level, you could get your directional move right. And if this volatility started creeping down while you were even directionally right, if this started moving down at a pretty quick clip, like you can see, this underlying likes to have those big drops right away, right? After it gets its spike, it really falls off quickly. Another reason why I don't mind getting in a little bit earlier on these options. When they turn around on the volatility, they turn around on a dime. So get me getting involved in somewhere right here. I'm not too concerned on a buy there. All right. But a buy up here, I would be extremely nervous because I know it wants to come back down into those levels. So please, if you take nothing away from this video, just remember that volatility is giving you that hint to whether or not you should be buying options or selling options, right? Everybody got that? If that's making sense to you, please throw a Y over there in the chat window. And hey, folks, don't forget that we are on Facebook as well, so you can comment over there too. All right, so volatility comes out, price comes out as well. It doesn't matter what the underlying does at this point. All we're concerned about is isolating what volatility does to our premiums. We know when the underlying goes up, our call options are going to go up, right? Because it gives us the right, the opportunity to buy, right? Puts are going to go down because it's getting away from us. We're not going to be able to sell it. We're not going to sell it down here when the underlying is going higher. So of course it's getting cheaper. So the directional moves in the underlying, I don't want to split hairs there. What I want you to do is just think about this concept of price and how it's reflected over there in the option montage. Because despite the fact that you and I have our directional assumptions, most people would sit there and say, hey, you know what? You come up with a directional assumption, you're 50-50 chances of being right. And it's, that's the same thing. Somebody can say, Wolfman, flip a coin 100 times. I bet you it ends up coming out 50% heads and 50% tails. Well, I'm a pretty good coin flipper, so I can break that rule. I can call it out before it ever happens, probably 90% of the time. But let's say rolling the dice, you can't mess with the dice, right? The dice supposedly are pretty equal. So that's a relatively even predictable type of event. But with this, throw it over there, guys. Have you guys ever been in a situation where you were like, you bought some options and you're just like, why are these options going down? You bought a call and the price just started going down, despite the fact that this underlying was moving higher. It's happened to the best of us. All right. It happens even at these extreme levels. I could buy it right here and think, okay, I'm at that extreme level and it still goes down and breaks below that area, or you got it like right here and then it still went a little bit below, right? That will happen. But what I'm trying to do is help you folks keep your powder dry when you're trading, right? If you know what's happening, you're going to be a little bit more calm, right? Some folks, when they don't know what's happening, that's where you really start to get the fear going on. All right, another example. Now, this was one of those ones, and I've recently found where it's actually had a paradigm shift a little bit higher due to everything that's going on around this underlying. So sometimes, even especially with mine, even in the watch list, if I can pull up my watch list here, I think it'll show it. Come on now. I don't want that. There we go. I want to get rid of that. All right. If you guys can see this over here, implied volatility for 6 months. All right. So what I've done is I've taken the script and I've eliminated, basically with my platform, it'll tell me a full year's implied volatility. And I like to go about 6 months out because that gives me a pretty good gauge as to what recent volatility is. And that one kind of works out with this because we kind of had a paradigm shift in its volatility. And I think the new coefficient is going to be a little bit higher for this. Now, I believe this was NVIDIA. And the reason why it's had that paradigm shift higher is because it is so correlated to Bitcoin and the cryptocurrencies. All right. So while volatility is increased in the cryptocurrencies, this one has increased as well. So this one, some people could split hairs with me on this and hey, I'm good with that. Some people could say that this one's high. I would say that, I would go with this upper band being the new range for at least the foreseeable future. I'm going to have to change if it starts breaking down, but for right now, I'm going to be looking at this one with a new paradigm. So sometimes it does happen. You do have to think for yourselves every once in a while. And one of our last examples is this one that I want to use for today. So it doesn't really matter other than the fact that I did tell you folks that you kind of want to wait for this to kind of make that little bit of a move to the upside before you start doing it, because you don't really, especially if you're a newer trader, want to get involved too early. But if it gets down to around this level, you should definitely consider those premiums cheap. All right. But I'm looking at it as we've got basically a pretty good line through the middle there. This is my buy zone. I'm going to look at it because, I just feel like this thing's going to make a move. So I need to make a decision. Am I going to buy or am I going to sell these options? Well, with this said, it being this low, I can see that it does have a tendency to kind of want to turn around when it gets down to this level. You could say that there's almost another support level in and around that 25-ish area, right? So I'm going to look for this as an opportunity to buy options with my directional assumption, right? So like I said, folks, you will come up with your directional assumption first, but I wanted to get this out of the way, and then we'll start talking about real life examples of trades. So volatility, if I haven't said it enough, do we have this? Throw a Y over there in the comment section. If you believe volatility does drive pricing, then throw a Y over there. And if you believe that we can determine, is that light bulb going off? We can determine price based on volatility. Now, here's the one we were looking at, Amgen. I'm looking at Amgen right here. Yeah, it's at the point of control, but I think that this market is either going to pop or it's going to drop. I'm not super concerned about, or I'm not super sure it's going to happen. Remember last week we talked about the straddle, right? We talked about the straddle. And we were talking about the straddle with a pop or drop as well. Now, with the straddle, I want you guys to be a little bit more confident in your directional assumption on this pop or drop. Like, I think it's really going to happen quickly. Now, why would I choose the strangle versus the straddle? Well, I choose the strangle versus the straddle when I'm a little bit less confident, maybe. I still believe that we're going to get a pop or a drop in this. I also believe I'm going to see volatility drive higher. Why? Because we've got an earnings call in there. And what usually happens coming into earnings, we can see volatility has, and maybe not right there, but it did a little bit going into there. But volatility has a tendency to drive higher going into those earnings. So I believe that while we might have dropped down a little bit lower over time here heading into that earnings, we're going to see volatility go higher. Well, what does that mean? It means prices in the options are going to go higher, right? Yes, for every ticket moves higher, our options premiums are going to move higher. That's a rule. It's like geometry. I was trying to think of geometry earlier. Like geometry, when you're doing geometry, you had to memorize all those rules, right? This is the same thing. This is the only one rule you really have to remember is volatility increases, prices increase. Options, well, maybe two. Options are all based on an advancement, all right? So I think it's going to pop or drop, but I'm a little bit less confident because if you guys watch the daily market commentaries or spotting the trade videos that we do in the morning, you guys know that I trade around the market profile. And when we get to the point of control, I do think that it's going to have a tendency to settle down a little bit. Why? Because price has met. We got a thunderstorm going on here, so I've got the dogs freaking out. So hopefully this goes off pretty good. So it will have a tendency to settle down there. Why? Think about when you've been trading. If you've been trading stocks a lot or a specific stock, when it gets to that price, right? And you know the price probably better than I do. When it gets to that price that you've traded several times back and forth, well, you're not so hot on trading that same price again, right? Even if you made money on it, you might be like, okay, well, last time I bought it here, I did make money on it, but I had to take some heat. I'm going to wait a little bit longer for this other price because I see it always go to there and kind of juke around. That's usually a point of control. It's a psychological level that we all have in our head because we've seen that price trade so much. We don't want to trade it anymore. All right. So it has a tendency to lose volume, settle down there. But I think right now with this type of environment, we are going to see a pop or drop. I don't think it's going to necessarily stick around here. I think we'll see some movement happening heading into that earnings and volatility. Even if this underlying moves sideways, I believe that I'm going to get volatility helping me. I think it's going to move higher and that will help me, right? Because if volatility is moving higher, price should increase. Now, yes, you guys might be thinking in the back of your head, well, if it does this, you're going to be fighting theta or that thief in the night, right? Yes, I am. I completely concur. I'm going to try and limit some of that theta component though, all right? And I'll show you how to do that as well. And don't be like the Apple option traders where they're buying front month options in extreme volatility, all right? If nothing else to say. All right. So before we get into it, let's really simplify these options, all right? I'm going to give you guys a couple of little, I don't know, floor trader hacks, I don't know, quips for you guys to be able to remember these options a little bit better. All right, so the first one we have is delta. Sorry, I have a dog like shaking me and everything else. First, we have delta. And the symbol for delta is basically change, all right, or a big triangle. So delta really tells us the rate of change. That's what everybody is going to tell you. That's what options 101 is going to tell you. We already talked about everything is about an advancement, right? So let's go back to an example. We'll say it's XYZ, all right? And I'm going to use an easy one. It's trading at 100, all right? Now, over here for delta, we have calls and we have puts, right? So let's just say we're talking about these options that are basically at the money. All right. So the at the money ones are the ones that are trading as close to the underlying as possible. So we've got the underlying trading exactly at 100. I'm going to look at the 100 calls. All right. Those 100 calls, let's just say, are trading around $1.50. I'm trying to make math easy for everybody, to $2. And hopefully I've got some of you guys out there with an abacus, because I'm not always very good at math when I'm trying to talk at the same time. All right. So we've got the calls and the puts. They're trading at about $1.50 to $2. They're right there at the money. So it's pretty easy to come up with it. Now, delta is going to have a column, and these are the strikes, but delta will have a column, and it'll say that the calls here are basically the at the monies, we're going to say are basically sorry, I don't want that, are a 50. All right, or 50 cents. Okay. The calls are going to be positive. The puts are going to be negative. So I guess I got to kind of do something like that. All right. So delta for the calls is 50 cents. For the puts, for those calls, is negative 50 cents. All right. Puts are negative because everything is assumed to be an advancement, right? The underlying goes higher. You don't want to sell a stock lower than where it's currently trading, right? Because remember, a put gives you the opportunity, or it gives you the right or the opportunity to sell the stock, but not the obligation, meaning you don't have to if you don't want to. All right. So as the underlying moves higher, puts are negative because that assumption of moving higher, and they're going to be worth less money because you aren't going to sell the stock down there. All right. But calls on an advancement are positive delta. All right. So if this underlying, if XYZ now is trading at 101, it's moved $1 higher. And we talked about this. Delta is based on $1 move. All right. So if the underlying moves higher by $1, our options that are at the money will increase or decrease by 50 cents. That's in theory. My boy Ron over there, I see you're out there. He's talking about skew. We have a lot of skew going on these days. So we'll have all kinds of examples, probably for the rest of the course, about skew, Ron. We're going to probably beat that horse while it's down. All right. So underlying moves higher by $1 now. Now our premiums are going to adjust by the delta. So these calls would increase now, and they would be, $2, right? Because they've increased by $1 to $2.50 to the bid offer. The puts are a negative delta, right? So those, while this dollar, we have that dollar move higher, are going to drop. So it's going to be $1 at $1.50. Okay. The calls are going to increase based on a positive delta. Puts are going to decrease based on a negative delta. Now, put your thinking caps on real quick. If the underlying moved down by $1, right, a negative plus a negative put delta would make that a positive. So if the underlying moves down, those deltas become positive to your position. All right. So underlying moves down, those options increase. All right. One thing though, everybody's talked about this. So I'm just really doing this part of it for some of you newer folks to trading options. But the thing we used to say on the floor is delta is data. All right. That's all it is. It's just telling us data. It's telling us the data of how much our premiums are going to increase or decrease. It also tells us probabilities. And one thing that I know you guys probably know out there is delta tells us the probability of being in the money by 1 penny at expiration. Okay. Some people say just going in the money. No, that's not true. It is the day you put on the trade, your probability of being in the money at expiration by 1 penny. Okay. So a 50 delta has a 50-50 chance of being in the money at expiration. stock. If you buy or sell stock, like I said, it's a 50-50. That's why the deltas on the at the monies should be 50-50, because it's a 50-50 chance. Now, on the floor, though, we used to say that 2 times the delta equals your probability of touch. All right. And that's just based on the fact of the ebbs and flows of the market, right? We can see a market rally up and sell off all day long. So that 2 times the delta means if I had a 25 delta call out there, well, I have a 25% probability of being 1 penny in money at expiration, at least 1 penny in the money. I could be $500 in the money, but it's just saying at least 1 penny. All right. That's your probabilities. But 2 times the delta is your probability of touch, meaning during the life of this option, those ebbs and flows, you have 2 times that deltas is your probability of touch. Now, the reason why I find this really important, folks, especially as a trader, is because our deal is to beat probabilities, right? We know the probabilities of success. And if we can beat those probabilities, we should take that to the bank. All right. So my rule is, if you're buying options or even selling options for the most part, the underlying moves, ebbs and flows to those target points during the life, you've beaten the probabilities. All right. So pull the ripcord on it, especially for this strategy. All right. I'm going to be looking for pulling the ripcord once I see my strike trade. All right. I'm not going to wait to the end of the day and try and get it 1 penny in the money, because if it's only 1 penny in the money, I'm going to lose everything. All right. And we'll talk about how that works out here in a minute. The next one is gamma. All right. Gamma usually has a pretty small coefficient. For the at the monies, let's say it's probably around 5 cents to make math easy. And really all gamma is, it's just a tag along. Gamma goes with delta. All right. We talked about delta. Delta was dollar number 1. This is the second dollar. All right. So now XYZ would be at 102. All right. So now gamma goes with delta. We know it's a 5 cent. So now gamma goes with delta, 50 cents on the first dollar. Now it's 55 cents on the second dollar for the call. So those on the second dollar move higher are going to be $2.55 at 305. Right. Now on the flip side, gamma is positive, all right, and gamma goes with delta. So on the second dollar, gamma goes with delta. We've got a negative delta plus a positive gamma. It's only going to decrease by 45 cents on the put side. So it's only going to decrease by 45 cents now. So now we're going to have this come down to 55 cents bid at 95 cents. I think that's it. Trevor, did I get it? That's what you were talking about. I think I see the problem. Oh, no, I didn't do it right. 55 cents, 45 cents come in. It's $1.05. Right? 45 cents comes out on this dollar. So it goes to 55, 45 cents comes out that. So we would see it be 55 cents at $1.05, right? On that second dollar move. So gamma just goes with delta on dollar number 2. And then we have the thief. All right, the thief is just theta. He's got that name on his back. Oop, theta. All right. The thief in the night is theta. And really what happens is every night he comes in and picks a penny out of your pocket, all right, or out of your portfolio on those options, all right? And it's not linear. It's not binary either. It doesn't just like happen all at once. It's a slow, methodical process that increases in urgency the closer and closer to expiration we get. So when I say it's not like linear, meaning it's not the same every time, what it does is it slowly increases and then it picks up and then it really drops off. So what we see is like at 7 days to expiration, we get a really massive drop off. That's usually where you're going to see like your gamma traders or day traders for the most part. And then basically we look out to about 35 days to expiration. and we can see the pickup start to happen. This thief has realized that he's got to catch up to you and start stealing some money. You can go out to about 40 days, 45 days. The expiration is kind of where I'll start entering some trades, but this is kind of like your sweet spot. And then way out here, 70 days to expiration, we see that this really is pretty consistent. It hasn't really started picking up too much. So when we're going back and forth on this, inside of this, if this is the price of your options without the underlying moving, what do you want to do inside of 40 days to expiration? Is this your buy zone? Do you want to buy options and watch that happen? Throw an N over there in the chat window if you don't want to see your cash drop in a buy scenario. No, you want to be selling here, right? This is your buy zone because it's still happening, but it's just not as extreme, right? You get in here, this is where I've always seen people buy options or trade options, just trade options in general, right? And they're going to be saying, well, because these options are so expensive, I don't want to pay that much. Folks, you need to be a good steward of your capital. You have to realize that if he's only taking a penny a night, well, it's worth paying $20 and he only takes a penny a night than to pay $5 and he takes 25 cents a night, right? Doesn't make sense. Be good stewards of your capital, all right? Buy zone, outside. I don't care if you go out 100 days, right? I'm going to show you why this is the sweet spot. You go out 100 days, really, you're not really limiting theta at that much at that point. So sell zone, basically going in from here, buy zone, going out outside of 45 days. I like to hit right around that 70, 65 days, something like that, somewhere around 70 days. I might have to go out to about 80 days right now, but right around that time frame is really where I look to buy options. All right, so you guys don't have to fear the Greeks. All right, so again, let's go into the real life example really quick. Take a look at what these option montages are talking about. We're looking at calls and puts, right? They're on opposite side. Then we've got the different months here. You can tell how far it is before they expire. All your strikes are lined up over here. They're the same for the calls and the puts, all right? Now, delta, we talked about those at the monies. You can see those at the monies closest to where the underlying's trading is right around 50, okay? We can split hairs on it being above or below, but it's pretty darn close on those at the monies. They're very close to 50 all the way across the board, right? Calls positive, puts are all negative, right? The advancement idea. So the underlying moves higher by $1 on these calls. These calls are going to increase by 7 cents, right? So the idea going further out in time, think about it. Theta is less aggressive out here. All right, I was talking about delta. So let's skip over to gamma goes with delta, right? We see that those coefficients are very much. Let's get on to theta. You can see theta is always negative, something I forgot to mention. Why? Because it's always based on an advancement and nobody's found a flux capacitor. So we're not going back in time yet. So theta is negative and he is always diligent. So we can see 120 days. What happens? We rally in. What is that? 35 days. 35 days. How much did theta increase? 1 penny, right? Now we come in. We go from 85 days to 55 days, another 30, almost 30 days. It's increased by 2 cents. All right. So it increased an extra penny on me. Now that I don't love, but I also don't hate it. So, it's going to be kind of up to you. I'm willing to take that extra penny. There's also going to be more trading going on here than here. Probably not as much trading. All right. So I want to get involved where there's a lot of people trading, makes good markets, all that jazz. But then we look at 50 days, another 30 days. What happened? Goes from 8 cents, and this delta is way off. You can see the 12 cents right there, 11 cents there. It's probably 12 cents at the money. So we've seen this now increase 4% or 4 cents. A little bit more painful. And then if you got involved here in buying options, what would happen to that theta? It almost doubles coming into that next, not even 20 days, right? So when you see folks out there talking about buying options and they're talking about that front month, listen, at least now you have the tools to know I don't want to be buying in front of this dude, right? I want to get out there where he's kind of not paying attention, all right? And then we can look at, like we said, theta on both sides, negative. Vega is always positive on both sides. And what we're basing this on is this number, right? 22. If it increases by 1 percentage point, what it's saying, it goes from 22 to now 23.01. All of these coefficients will go into its corresponding option, all right? 1 percentage point increase. I'm not even talking about this underlying moving at all, right? Just the volatility increases by 1 percentage point. These volatility coefficients are going to jump into those premiums. Now, look out here. Further out in time, much bigger volatility. Volatility affects further duration options more than nearer duration options. And the reason why is what's going to happen tomorrow or the next day, right? You got a pretty decent idea of what's going to happen in the next few days. Well, maybe not so much recently, but generally speaking, we got a pretty good idea. We know the Fed's talking about another 75 basis point move higher. But what do we know 3 months out? I mean, we don't know. Maybe the Ukraine war starts, the tensions there ebb, 100 days out. We don't really know. That's a lot more difficult to see what's going to happen 100 days out than, 100 minutes out. So volatility is going to affect those further duration ones more because there's more unknown out there. All right. So volatility as it ebbs and flows is going to affect those further duration options. Again, a reason why we want to get in when there's low volatility, go back out in time, limit that theta decay. And then when we get the volatility spiking, then that helps us. All right. We want to get involved in volatility to sell it when it's high up here. So we have theta in our back pocket to help us with our probabilities of success, right? That's all I'm trying to do here, folks. That's really cracking the code to trading options. Mostly volatility and how it's going to affect your premiums, but all in all, these levers and pulleys to make sure you're, from now on, you don't have to watch, those guys on CNBC always talking about buying options. They have a different fiduciary responsibility. As a matter of fact, they can't really say they're selling naked options on TV, folks. They'd be probably having calls from everybody from FINRA to Standard. I don't know. Everybody would be calling them. Every legal stock agency would probably be calling them. The SEC, FINRA, I don't know, everybody. So that's why they don't ever talk about selling options, especially naked options, because they can't. All right. I don't have that fiduciary responsibility, but I can't really tell you what types of trades to put on either. So mine's a little bit different. I can tell you can sell options if you are comfortable in pulling that trigger yourself, or buying options if you're comfortable pulling that trigger yourself. All I can do is show you really the levers and pulleys of these markets and how it's going to affect your trading. Okay. I'm not going to tell you what you should do on your directional assumptions or any of that stuff. I'm never going to come out there and tell you this is a great bullish trade. You won't hear me say that. You'll hear me say, I think this is a good bullish trade. It's up to you to come up with your assumption on directionality. This, what I'm talking about, are just facts. This is how the markets work in the options. We already talked about it. We've seen those levels. So we know that when it's getting down here in the 20s, that for this underlying, it's pretty low, right? If we saw it up at 45 right now, we would know that this underlying, based on looking at the option or based on looking at the implied volatility chart there, we know that those levels are either cheap or expensive. I mean, it's just facts, guys. So let's go. What did we find with our trade? Well, we discerned, or at least I did. My assumption here is that we are going to get a pop or a drop. That's the first thing I come up with. All right. First idea is I got a pop or a drop. Second step, immediately go down here and look at the options and say, you know what? I'm drawing that line in the sand. That's 50-50. I know they're expensive when it gets above it. Right now, they're pretty cheap. So I would need whatever directional assumption I have. I just know that if I'm going to pick a trade, and I need to make sure that I'm buying an option strategy to meet my directional assumption. Mine's a pop or drop right now. So I need to buy some type of strategy, right? We talked about what we do for the straddle, right? We need a bit of pretty decent move quickly for that straddle. And I want it to happen relatively quickly. This is one where I'm a little less sure of that pop or drop, but I truly believe that that's what we are going to see happen. So I'm going to take a little bit of risk off the table. I'm going to go for the strangle and play my pop or drop. I know I've got to be a buyer of options, okay? So that's the first thing we do. And then go to, let's simplify options. I went back to that. All right. We already got through. I don't really want to get in that, 57 days because I already saw what's going to happen. If I'm in this for a week or so, I'm going to really start seeing theta start to jack up. So I'm going to step out, go outside of that 70 days to expiration that I talked about, limit that theta decay, be a good steward of my capital. I know the volatility is extremely low, 25. We already saw that on the chart that 25 is low. It may get down to the 20 area, but we can see that it's got a lot of room to the upside. Another thing I talked about, driving volatility is an unknown or a binary event is going to be something that will spike volatility. All right. So I've got that in my back pocket as well. The belief that volatility is going to expand. I've got a binary event over there. I can see in the past binary events. We get those jacks heading into those earnings, right? Doesn't always jack up, parabolic, but it does rise into that unknown. So even if I'm directionally wrong, underlying stays here, that volatility, that angst starts building up, those prices are going to start increasing, okay? So what we can see is those prices will start increasing. There was a thought I had in my head on the volatility. So if the volatility starts increasing, right, and we saw it was at extreme levels, we got 20 percentage points to the upside to get to that 45. If you're looking at volatility again, if you multiply one time, right, 1 percentage point increase, 46 cents goes into these premiums. What's 10 times, 10 percentage points? That's $4.60 going into those premiums, right? That's some pretty good money. So while we're talking about volatility increasing and stuff like that, we could see that the volatility coefficient and the delta are relatively close, right? So we could see this underlying move a couple of dollars and volatility really ratchet up. Well, that volatility could offset any type of move with options, right? You could see that if the underlying moved higher by $1, right? If we said this underlying, hopefully I have my pen up. If we were looking at this option, right, and we said the underlying moved higher by $1, well, 48 cents goes into it. What happened if volatility went down? Where is it? Volatility went down by 1 percentage point then. Well, this would become a negative. It would almost be offset, right? $1 move higher at a 1 percentage point downtick in volatility offsets it. All right. Guys, if you had a light bulb moment during this video, please hit the Y button for me. All right. So offsetting that. So why would you be buying in high volatility and shorter duration? You got theta, like we get a little bit closer here. You got volatility. may not offset completely dollar for dollar, but then you got this big theta component running against you as well. So you're getting yourself mixed up into all of these levers and pulleys that you shouldn't be. What you should be doing is turning the tables into your favor, right? Limit theta decay by going out in time. Be a good steward of your capital. That's the buy zone. Well, volatility affects those premiums the most. That's another reason why we go in there. Sell zone, inside of 35 days to expiration. Why? Because of theta. We got that theta component really jacking up. So that will help us despite the fact that we are directionally wrong. We've got theta eroding those premiums. That's good for a sell trade. Well, if the underlying is going against us and theta is fighting it, that helps us out. So we want to make sure we have all of those levers and pulleys helping us. Now, back to this trade. Should we talk about the trade yet? All right. The trade here. I picked, like we talked about, the straddle. Straddle's pretty easy, right? Those are just the at the monies. You're picking the same strike at the monies. Would have been what we talked about last week. But on a strangle, all right, equal distance away. I'm looking at being equal distance away from the 145s because that's close. Well, on this last print there, it was closest to it. So that's why I picked that one and then went equal distance away. Well, how did I pick that equal distance away? I like to go for somewhere right around that 25 delta. All right. Now you could say, well, there's a 25 delta right there on the puts. Why did you pick the 130s? It's because I actually went to the calls and went first to look for the closest to 25 and then went down to the 30 there. Equal distance away. Very close to that 25 delta. I didn't love it going out to the 20 delta to get that further out 25 delta. All right. Now, why do I pick that 25 delta, folks? Anybody? It's got only a 25% probability of being 1 penny in the money. I've got this strangle on, right? I think it's a pop or drop. I'm picking that because I know 2 times the delta equals your probability of touch. So yes, it is negative. Okay, we got to put those little lines on there to make it like, whatever you call it. I forget that math term when you throw it over there in the comment section if you guys remember when you neutralize a negative. But anyway, 2 times 31, that means it's a 62% probability of touch, right? Over here, I've got a 27. That means it's a 54% probability of touch. Much better than finishing 1 penny in the money. So what my play is this underlying is either going to pop or drop. And once it hits my strike, I'm going to pull the ripcord on, right? Absolute. Zeke comes to the rescue, the absolute value. Exactly. So in that one case, that's when we're going to do the absolute value. No, you do not have a negative 62% probability of touch. All right. It's still a 62% probability because it's 50-50 in either direction. All right. So 2 times the probability of touch. That's why I'm picking that 25 delta. Now, when I'm selling options, I'm picking like the 16 delta. And we'll talk about that going forward as to why we do that as well. But for buying options, I want my option to go in the money. When I'm selling options, I don't. So I want high probabilities of touch. And that means I'm going to go for that 25 because that at least gives me a 50-50 chance that that's going to get hit. All right. So I'm going to play that all day long. So at the end of the day, when you're looking at this option outside, 70 days to expiration, greater than that. So that's why I'm picking off that option. We already saw that this volatility is low for that underlying based on us charting it out. That's 24, 25. That's pretty low for this underlying. All right. And then I'm buying out here because that volatility jacks up. I get the best volatility coefficient for buying. All right. I'm going to get in there, buy it, jacks up, limit theta decay, all of that stuff. Does anybody else have any questions before we roll out of here? You guys, we can take a look at another stock.
But ultimately on this, break even, I wanted to throw, that's why I forgot to throw the analyze tab on here. Break even on this, what you want to do is I paid $10.10. At expiration, I need to be at least outside of that 60. I need to be trading 60 plus this debit. So my break even to the upside is 270 at expiration, right? Or 220. Now, those seem like very extreme levels you have to get to. But remember, that's at expiration. Remember, because I paid a debit, that option that I bought is going to basically be worth almost nothing if it's out of the, it's going to be worth nothing if it's out of the money. But if it goes in the money, I need to make up at expiration that 10 cents or that $10. So it has to be $10 in the money at expiration, right? So another reason why during the life of this, tomorrow it goes up there and hits my strike, I'm going to pull the ripcord on it, guys. My idea is we're going to get a pop or drop. I get that pop or drop, I'm going to hit it when it gets to my level. So your break evens are going to be, 270, which is pretty steep. We're looking above previous high there. That seems pretty lofty right now. 270 what was it? 230, 220 to the downside. So basically coming to this extreme, 220, I think it was off the top of my head. 45 to 30. So pop or drop needs to happen. If it comes down and hits my 230 strike, which is way up here, right? 230 strike, and the other one was the 260 strike. Those seem like much more achievable levels, don't they? So that's why I'm going to go and beat the probabilities. It comes down, hits my strike. I get that kind of move really quickly. That's why I want to pull the ripcord on this when I get 2 times the delta. And this was delta on the floor. What's the delta? All right. Delta's 50. All right, folks. That's about all I got for you. Unless you guys have some questions for me. I'm going to throw this out there for you. Also, I have it over in the chat window right now that you guys can click on. That's a hot link. This is obviously not a hot link. You guys can take advantage of this. You get over 15 hours of content protecting your portfolio against rising interest rates. Is anybody, if you're under a rock, you might not know this, but interest rates are moving at a clip that we haven't seen since the 90s. So basically 75 basis point move. Well, I show you in this video, basically, if you have a $250,000 bond portfolio, this last couple of interest rate increases of 1%, you probably saw that bond portfolio that was $250,000 is now looking like 200. All right. Folks right now are trying to dump their bonds. They're selling bonds like they're going out of style because they want the higher yield on these new bonds. Well, listen, guys, traders like me, they know what you're doing. They're bidding so low that you could never get out of that bond, get into a new bond, and make up for it with a coupon. You're going to end up losing money or be completely sideways on it, right? So I show you different ways to trade in your portfolio and keep those bonds there. Yes, you're going to have to hold on to them for a lot longer, wait till they expire or something like that. But at the end of the day, you won't be losing money on it. At least not as much, I should say. Can't make any guarantees. Market profile, I'll show you how to trade around that market profile for that. Appreciate you. Thank you for the kind words, everybody. I see everybody starting to roll out. Before you roll out, please smash the like button, hit the subscribe button. Don't forget the bell because the morning videos are unannounced. It'll show you I'm coming in around 6 or 7 o'clock in the day, depending on when I come in. But usually when you see that thing show up and it says a time, you know it's imminent, all right, or some along those lines. But if you've subscribed, hit the bell, you'll know, you'll get those notifications there. And that's where I really talk about my trades a lot more. And market analysis, all that good stuff. All right, a lot of other good things that you'll find in there. This is a little bit better breakdown of what you'll find. A lot more videos in there. Like I said, well over 15 hours of content. And basically when you're done watching a video, you check it off. 36 bucks, folks. I think it probably saved you guys $36 today. But if you just never buy an option in the front month again, please don't do that. Please don't be that guy that I'm making fun of on these videos. I will make fun of you. I know I will make fun of you guys because you guys are on it. All right. So appreciate it again. Thanks, guys. Like I said, that's it. Links in the window. This is what you get. 36 bucks. I think I've already done that for you. Don't forget to smash like, hit the bell, and thanks for commenting. One last thing. You can't take that. Take it easy. Thanks, guys. Bye for now.